What is going to happen to our property markets in 2012? Hi everyone, this is Nick Burke from propertyforprofit.com.au, and I'll be answering this question on this video. However, I must start by saying that I'm very reluctant to weigh into broad predictions of what's in store for our property markets, because this space tends to be dominated in the media by many so-called experts who make predictions that turn out to be wrong about as often as they turn out to be right. It's true. Many commentators are right on average about as often as a flipped coin at best. And when they're right, it's often down to luck as much as it is down to any expertise. So I thought it's time to cut through all the nonsense, all the noise. What I'm going to be revealing in this video is state by state which areas to invest in, which areas to avoid, and some critical things that investors need to look for to make sure that 2012 is another successful year for property investment. So let me start by reminding everyone that there is no such thing as the property market. There are, of course, hundreds of property markets throughout Australia. We have around 15,000 suburbs and towns, and the universal factors that affect all of them, like interest rates, are not as important as the individual factors that affect each of them, such as local industries, population trends, local sources of income, and infrastructure projects. One of the things that annoys me about the commentariat is that generalisations are made about the Australian market as a whole. Given the composition and the diversity of our huge country, it makes little sense to me. Also, when the data is broken down state by state, it usually refers to the capital cities and takes little or sometimes no account of the regional areas. And as we've seen in the last couple of years, it's the regional areas that are offering the best capital growth opportunities as well as the best cash flow. Now, whilst that annoys me, I'm actually quite glad it happens, because it creates plenty of investment opportunities which go by unnoticed to the mainstream. So we're going to take a look around the country at what you can expect from our property markets in 2012. But first, let's start with Europe. This is the big question on everyone's lips, and Greece in particular. What if Europe or Greece, or the whole lot, does in fact implode? Is it going to affect us directly, or is it going to have a major impact on our big customers like China, which might also affect us and our beloved property markets? Well, make no mistake, Australia's future is much more closely linked to Asia than it is to Europe. Not just China, but emerging Asian countries like India, Indonesia, and the rest of emerging Asia. This is a view shared by many commentators. The International Monetary Fund is still predicting Asian economies will grow by around 6.7% in 2012. China will grow by around 9%, Australia by around 3.3%. Even though Asia is not, as they say, decoupled from many advanced economies. Many of the more plausible commentators stating that a default by Greece, which if it does spread to the rest of Europe, while grabbing a lot of headlines, will be unlikely to affect us much here due to our connections with Asia, our low debt, our safe banking system, our ability to drop interest rates if necessary. These are the things that were deployed last time and that were relevant last time during the GFC. This is basically a summary of the views of Paul Braddock, Head of Property and Financial Research at ANZ, and Dr. Shane Oliver, Head of Investment Strategy at AMP Capital Investors, who have commented on this matter. Shane Oliver says that even if Europe does enter a deep recession, and even if this does affect us badly, the worst case scenario, there are many different scenarios, but let's discuss the worst case. The worst case, he says, would be a recovery about a year from now, in early 2013. And this is the worst case. So if anything, this suggests 2012 would be a good buying year. Still not convinced? Well, it's happened before, hasn't it? Not that long ago. The GFC was only a few years ago. What happened then? Well, I'm going to make one of those countrywide generalisations now that I hate. Across the country, if we average everything out, prices went down about 4%. Then, the following year, 2009, they went up 9%. And most people were caught napping, sitting on their hands, reading all the headlines, worrying about what's going to happen, and listening to the doomsdayers when, in fact, it was one of the best buying opportunities for a long time. I got caught out. I missed it. I didn't buy anything that year. I'm kicking myself now. But if Greece creates a kind of a GFC Mark II, I certainly know what I'll be doing. And so will you, because we've seen it happen before. So, the two big macroeconomic issues you should be watching during 2012 are interest rates and unemployment. Interest rates starting to fall will tell you that we're close to the bottom of the cycle, or starting the the upturn of the new one. Unemployment will rise a little, probably around 5.5%. So when this small expected rise has run its course, probably around the middle of the year, maybe a little later, it's time to look for an upswing as jobs are created and unemployment starts to fall again.